In 2003, the number of new homes that were available for sale in the United States stood at roughly 300,000 units. By early 2007, that number had doubled to 540,000 new homes on the market for sale. This massive increase in the home supply sowed the seeds for the financial crisis that followed. But it's not just 2008. We've seen this happen several times throughout history, where a big boom in housing construction leads to an oversupply of homes, which is followed by some kind of an economic crisis in the year that follows. And today, we've recently seen the number of new homes for sale in the US jump again from 300,000 in 2021 to now roughly 500,000 homes, the highest level since 2008. If history is repeating here, it could be that the housing market is currently flashing a major warning sign for the economy today. The housing sector contributes to a total of 15 to 18% of total US GDP. This includes things like construction, renovation, rent, and services. So a slowdown and contraction of the housing market in the US already mechanically drags down the overall GDP. But it's not just a part of the economy. The housing market is also a leading indicator of the rest of the economy. So in other words, when the housing market weakens, it tells us that the economy is likely to weaken next. And there is clear evidence to back this up. Historically, almost every major economic downturn from 1968 to 2020 was preceded by a decline in existing home sales. We can zoom in on 2008 to see exactly why this happens. When the housing market weakens, what you typically see in the year that follows is that purchases of furniture, electronics and appliances, building materials, garden equipment, and countless of other things begin to struggle and even decline, leading to an economic contraction. So less home sales directly translates into less demand for a whole series of goods and services that are related to housing, which can already slow the economy down. But even more importantly, housing weakness provides vital information regarding people's ability to spend. Buying a home is one of the most important purchases of a lifetime for most Americans. So if the number of homes being sold is declining significantly, it probably means that people are in a weaker financial situation. If they're not even able to save up enough money for a home, it's very possible, even probable, that they'll begin to cut back on their spending in other parts of their lives, and so potentially dragging the economy into a recession. Now, if we look at what is happening in the housing market in the present day, we've seen a 40% decline in existing home sales. Historically speaking, that means the economy either is already in or should be heading right into an economic downturn. But if we zoom in a little bit closer, we see that things have actually been playing out very differently today. The drop in home sales, which started 3 years ago, has not been followed by weak retail sales from the sectors that we mentioned before. In fact, all of them remained very resilient to this day, holding up well above pre-pandemic levels. There is something else that's happening here. One possible explanation is that the housing market that we're seeing today is not actually being driven by real weakness in the housing market like previous recessions, but instead by the housing shortage that is currently present in the United States. We can see that by looking at this chart of US existing home inventory. And currently it's telling us that housing inventories is at one of the lowest levels in over 20 years. That already tells us that the drop in existing home sales isn't necessarily being driven by a collapse in demand, but rather that people are just not looking to sell their homes right now. This is definitely not the same situation to 2008, where existing home inventory was sky high at the same time as home sales were dropping like a stone. That was reflecting a truly weak housing market and hinting at the underlying economic weakness that was going to follow. Today, there is a major housing shortage in the United States that is skewing all of the data on the housing market that we have. This is a shortage that stems from a combination of underbuilding after the Great Financial Crisis, rising demand from millennials, and also increased construction costs. There's more evidence of this housing shortage on this chart that tracks the time that it takes to sell a newly completed home. It's currently sitting at just 3 months, which is not only far better than the 7.5 months we saw at the onset of the 2008 financial crisis, but also lower than the long-term average of around 4 to 5 months of the last 40 years. A higher length of time to sell a home is a signal that the housing market is actually weakening, as lower demand naturally leads to a slower market. Today, homes are being sold at a record pace, not really reflecting the underlying weakness that we talked about before. So what about that chart at the beginning of the video that showed a record number of new homes currently coming into the market? Are all of these homes being swept up at a record pace as well? Well, when we dissect the data on new houses for sale by their stage of construction, we see that the majority of these homes are either still under construction or haven't even been started yet. In fact, only 20% of the current home inventory is made up of completed homes. That's a stark contrast to 2008, where the bulk of the supply was fully built and flooding the market. The excess in new homes that were actually built, plus the actual underlying weakness in the economy in 2008, set the stage up for a big downturn in housing and a big downturn in the economy. Today, when we look at the number of new homes on which construction has not even been started yet, it's at record highs. So this tells us that new homes are being built and that could solve the housing shortage. And it also tells us that we're at least a couple of years out from seeing actual weakness in the housing market, because most of these homes that have not even started yet won't come into the market for another couple of years. This is not unlike the big wave of construction that we saw in 2004, 2005. This building frenzy did set the stage up for the housing market that we had in 2008, but that was only 2 to 3 years later. So while on the surface level, it may look like we're about to witness a second housing crisis, the reality is today's situation is a lot more complicated and not necessarily pointing to imminent economic or housing weakness over the next 12 months. So we are still quite confident in our bet on risk assets. We're long on financial markets today, as we think the economy will remain resilient over the next 6 months, as long as we don't see a huge escalation of the trade war or a big oil shock. We recently booked a 9% profit on CTVA, a fertilizing company that's been rallying hard as tensions in the Middle East have escalated. We booked an 8% profit on a semiconductor stock called KLAC, and also a 9% profit on IBM, and also an 8% profit on silver. These are all positions that we still have on our list of active trades at bravosresearch.com, and that we're updating our members on every week. If you want to have access to our entire trading strategy, make sure to click the link down below. Thank you for watching.